I don't really know, Mel, and welcome to the show. It's great to have you. I'm trying to ignore the day-to-day volatility. I'm trying to focus on fundamentals, both from the economic data that we're getting as well as earnings, and we're in the thick of it in terms of earnings, and I love it because we're learning all kinds of things. And I'm trying to use the distortions in the volatility in the market to look for opportunities. So from the economic point of view, we got a really good ISM number. We're 20 months in a row, by the way, of above 50. That's expansion. The prices paid was very hot, so inflation, we know, is alive and well. The JOLTS number is up 61% year over year. These two data points are important because the first quarter, we know, is slow because of Omicron and also supply chain issues. And so we're probably going to see a 2-3% GDP number in the first quarter. Second quarter, as we hopefully get through Omicron, we get a little bit more easing in the supply chain, you're going to start to see a little bit better growth, above trend, 3-4%, maybe even more than that. And I think you're going to see, if the Fed is under control and doesn't go crazy, you'll see about that for the remainder of the year. That's why I actually do have more cyclicals and reopens and more value names in my portfolio than kind of defensive growth. So then that's just on the economic side and the data points there. On the earnings side, we've gotten a whole host of companies, and you know, they're pretty decent, but some of them are selling off, and I'm making my shopping list. And this is exactly why I have a little extra cash, and I have been buying. We'll get to the buys later. But some other names that are on my shopping list, IBM had the best cloud number in a decade, trades at 13 times, and it has almost a 5% dividend yield. JNJ, double-digit pharma growth. It's just consistent double-digit. A strong med tech business. That's part of the reopen as utilization rates improve. And they're spinning off consumer. What more could you ask, especially at 16 times with a 2.2 yield? American Express, the hero of the financials so far in my book, beat on earnings, revenues, net interest income. Build business was up 29% year over year. They increased the dividend, and they're guiding 18 to 20% revenue growth. That stock trades also at 16.5 times. So you get the point. The real kind of messy ones, GE and Boeing, you got to sift through that noise. And I think the free cash flow numbers at both companies was very impressive. And that's what I'm looking for at this stage in the game for those companies. So there's a whole litany of names out there. And you got to use the volatility in the marketplace because I just don't know if we're at the bottom or not. And a lot of it's going to be dependent on the Fed and on the economic data and that sort of thing. So I'm trying to look at and concentrate where I'm seeing real value. And there's a bunch of them on my list.